Imagine you are standing on the rim of an open pit mine in northern Alberta. Below you, trucks the size of three-story buildings crawl across a landscape so vast and so black it looks like the surface of a distant planet. The scale is genuinely difficult to process. Each of those trucks moves more material in a single shift than a small construction company handles in a month. The infrastructure surrounding you, the pipelines, the upgraders, the processing facilities stretching to every horizon represents one of the largest and most capital-intensive industrial projects in human history. It looks like wealth. It looks like permanence. It looks like the engine of a serious nation. Here is what it actually looks like to a global energy investor in 2025. A VHS tape factory in a streaming world. Canada sits on the fourth largest proven oil reserves on the planet. Only Saudi Arabia, Venezuela, and Iran have more. On paper, that makes every Canadian citizen a stakeholder in an energy empire valued at somewhere around $1.5 trillion. And in practice, that number may be one of the most dangerous figures in the country's economic history, because it assumes a world that is disappearing faster than any pipeline can be built to serve it. What economists now describe as the $1.7 trillion mirage begins with the physical nature of what Canada actually has in the ground. This is not the light, sweet crude that flows freely from Saudi Arabian wells at a production cost of $10 to $20 per barrel. Canadian oil is bitumen, a substance so thick and viscous at room temperature that it resembles cold molasses mixed with sand. Getting it out of the ground requires either stripping away entire ecosystems through open pit mining, or injecting enormous volumes of high-pressure steam underground to liquefy it enough to pump. The energy required to extract Canadian oil is a fundamental part of why it carries the highest carbon intensity of any major oil-producing nation. And here is where the arithmetic of a stranded asset begins to reveal itself. For many oil sands projects, the break-even price, the minimum a barrel must fetch on global markets just to cover operating costs, sits somewhere between $40 and $60. If global climate commitments ever produce serious policy action, or if China and the United States simply continue scaling electric vehicles faster than Canada can build export infrastructure, oil price scenarios in the $30 range become plausible. At $30 a barrel, roughly a third of the Canadian oil sector's valuation does not soften, it evaporates. This is what stranded assets actually means in practice. Not a gradual decline, a controlled demolition. Alberta's provincial budget has already begun showing the early tremors. As of late 2025, the province is carrying a deficit of around $6.5 billion, driven partly by a drop of nearly $1.5 billion in resource revenues in a single year, against a backdrop of more than $80 billion in taxpayer-supported debt. A province that never built a serious diversified economy is discovering what it costs to run one when the core revenue source begins to soften. No single decision illustrates the trap more clearly than what happened with the Trans Mountain pipeline expansion. A $35 billion bet on a future that may have already closed its doors. The story begins in 2018, when private capital was fleeing Canada's oil sector with unusual speed. The company originally contracted to expand the pipeline, which runs from Alberta to the British Columbia coast, concluded that the regulatory complexity, the Indigenous rights litigation, and the political turbulence made the project unfinanceable. They walked away, and the federal government, in a move that left economists on both sides of the debate completely baffled, stepped in and bought it. The purchase price at the time was $4.5 billion. The strategic logic, at least on the surface, was coherent. Canada was selling virtually all of its oil to a single buyer, the United States, which meant American refiners had effectively captured the Canadian oil market and could extract a permanent price discount simply by being the only option. Reaching the Pacific coast would open routes to Asian markets and, theoretically, break the American pricing stranglehold. What followed was one of the most spectacular cost overruns in Canadian infrastructure history. The final construction bill landed at $35 billion, roughly 8 times the original purchase price, and approximately $1,000 for every man, woman, and child in the country. By the time the expanded pipeline reached its operational capacity of nearly 900,000 barrels per day in 2025, the world it was designed to serve had shifted beneath it. Shipping heavy bitumen from British Columbia across the Pacific Ocean is expensive. The pipeline tolls required just to service the debt on a $35 billion project pushed those costs higher still. And when Canadian oil finally arrived at the door of potential Asian buyers, it found Chinese refiners gorging on deeply discounted Russian crude that had been rerouted after Western sanctions. Canada had spent decades and a national fortune building a door to the world and opened it to find the neighbours already had another supplier. The toll structure has produced a trap within the trap. If the pipeline operator charges tolls high enough to recoup the construction cost, oil companies find it cheaper to ship by other means or simply reduce volumes. If the government subsidizes the tolls to keep oil flowing, Canadian taxpayers are effectively funding the profit margins of some of the wealthiest energy corporations on Earth. There is no clean exit from this arithmetic. While the pipeline debate consumed the country's attention, a quieter catastrophe was accumulating beneath rural Alberta, one that carries a price tag that makes the Trans Mountain look like a minor budget line. Picture a farmer in the province's heartland who walks his north pasture one morning and finds a rusted pipe protruding from the soil, surrounded by a ring of dead grass and the faint smell of a well leaking gases underground. He calls the provincial regulator. The answer he receives captures the core of what has become one of the largest unfunded environmental liabilities in North American history. The well is an orphan. The company that owned it declared bankruptcy. There is no one left to pay for the cleanup. The orphan well crisis is what happens when an industry is allowed to externalize its end-of-life costs across decades. The mechanics are straightforward and have been standard practice for generations. Large, well-capitalized oil companies extract value from productive wells and then sell the aging, declining assets to smaller firms with less financial cushion. Those smaller companies squeeze out whatever revenue remains, and when the cleanup costs finally exceed the residual production value, they fold. The liabilities transfer to a provincial orphan well fund. The original company that captured the profits has long since moved on. Official estimates from Alberta's energy regulator place the remediation cost for all inactive wells at somewhere between $30 and $60 billion. Independent analysis and documents that have surfaced publicly suggest the real number accounting for sites not yet formally classified, and long-term environmental monitoring may be closer to $260 billion. Canada's entire federal budget for 2025 is roughly $500 billion. The potential cleanup bill for one province's abandoned oil infrastructure represents more than half of the national government's annual expenditure. The fund designated to address this was operating in 2025 with an annual budget of around $140 million. At that rate, clearing the current inventory of sites would take well over a century, not accounting for the thousands of additional wells that will be orphaned as consolidation and aging continue. Meanwhile, the global financial system is applying its own form of pressure on the industry from the outside. The dirty oil label is not merely an activist slogan. It is a measurable variable that institutional investors are required to track under environmental mandates that now govern trillions of dollars in managed assets. Canadian oil sands producers have made genuine engineering progress on emissions. Intensity greenhouse gas output per barrel produced has fallen roughly 28% since 2009. But the global investor community is not grading on a curve. Compared to conventional light crude from other major producers, Canadian bitumen remains meaningfully more carbon intensive. The European Union's carbon border adjustment mechanism is beginning to impose tariffs on imports that cannot demonstrate low-carbon credentials. For a fund manager in London or Frankfurt operating under a strict environmental mandate, Canadian oil is a reputational liability regardless of its intrinsic value. More than 80 Indigenous communities along the Trans Mountain corridor have signed agreements worth nearly $700 million in total. This transformation is not without its own tensions. Deep divisions exist within Indigenous communities over whether economic participation in fossil fuel infrastructure represents a path to sovereignty or a bargain that sacrifices the land for capital. The moral geography of this debate does not resolve cleanly into any simple position. What is clear is that the terms of engagement have changed, and the industry that once treated consultation as a compliance exercise has discovered that shared ownership changes the legal stability and speed of approvals in ways that no regulatory reform has managed on its own. While these geopolitical and financial pressures build from the outside, a quieter transformation is reshaping the human face of the oil patch from within. Major producers were operating fleets of fully autonomous haul trucks at their mine sites. By 2025, machines that run continuously, without fatigue, without overtime pay, and without the camps and amenities a human workforce requires. Production volumes in the Canadian oil and gas sector grew by nearly half between 2012 and 2025. Direct employment in the sector fell by 17% over the same period. The calculation that once made northern Alberta, a one-way ticket to a six-figure income for someone with a high school diploma and a willingness to endure difficult conditions, has been quietly renegotiated by software and automation. The province's pivot is to position itself as a hub for artificial intelligence data centers, facilities that need enormous quantities of electricity and cold ambient temperatures to prevent servers from overheating. Alberta has both. The pitch to technology companies is essentially, let us be your computing infrastructure, the way we were once your energy infrastructure. Whether a workforce built around heavy equipment operation can retrain for data management roles at the speed the transition requires is a question that no economic projection has answered convincingly. This is the condition that economists describe when a resource economy reaches a critical juncture, what is sometimes called a form of Dutch disease in its most advanced manifestation, when a single commodity dominates an economy so completely that the currency, the labour market, the provincial budgets, and the national political conversation all orbit around it. The capacity to imagine and build something different atrophies, not because the people lack intelligence or ambition, but because the incentives consistently reward extraction over invention, and the timeline of extraction always seems long enough to make the transition feel premature. Canada has perhaps a decade measured optimistically to convert the cash flow from its oil industry into the infrastructure, the education systems, the industrial capacity, and the political consensus required to anchor a different kind of economy. Lithium deposits exist in the country's geology. Hydrogen production from renewable sources is feasible in multiple provinces. Wind and solar resources in certain regions are among the best on the continent. Clean energy employment projections suggest that millions of jobs exist in a decarbonized future, but projections are not plans, and plans are not pipelines, and pipelines took $35 billion and the better part of a decade to deliver results that fell short of the promises made to justify them. The $1.7 trillion sitting beneath Alberta's surface is not going to disappear overnight, but the conditions under which it can be profitably extracted are narrowing with every electric vehicle that rolls off a Chinese assembly line, every solar gigawatt brought online, and every year that the orphan well liability compounds without a serious remediation program. Canada is not a poor country making obviously bad decisions. It is a wealthy country making slow decisions in a world that has stopped waiting. And the question that the next decade will answer the one that no pipeline, no carbon capture project, and no trade negotiation can resolve on its own, is whether a nation that built its modern identity around what lies beneath the ground can reimagine itself around what it might build on top of it before the window closes for good.